A deferred sales trust is a financial strategy used by property owners when they dispose of their assets, usually because they can't or don't want to complete a 1031 exchange. It basically takes the concept of something that is very familiar with even novice investors, the concept of seller carryback or seller financing. That is, when the seller has equity in the property and acts as the lender for the new buyer. The buyer then makes payments to the former owner as if they were the bank. However, most sellers usually trade up after a successful sale to a larger property and they purchase a new one. This is called the 1031 exchange, and I discuss it in more detail in my 1031 deferred exchange video. Without going too much into detail, 1031 exchanges have a specific time limit to identify and purchase a new property. Well, what if you can't find a new property in that time frame? What if the real estate market is headed downward and you don't want to buy a new asset that you think is going to lose you money? This is where the deferred sales trust comes in handy. It gives you a final lifeline to place your money so you don't have to pay all the taxes that are normally due from a sale all at once. I'm going to run through an example with you to give you an idea of how this could benefit if you're trying to sell a property and decide you don't want to reinvest and do a 1031 exchange. Let's say you have a commercial building that you originally bought for $1 million cash and is now worth $2 million. You sell the property and for whatever the reason may be, you don't do a 1031 exchange. But you still don't want to pay your capital gains tax. Now, to make this a very rough estimate, if you buy a $1 million property and sell it in 5 years for $2 million with commissions, your capital gains taxes would be around $132,000. Not only that, but the cost recovery amount due is another $23,000. That's a total of over $155,000 that you're going to have to pay now because you didn't exchange it to a new property. Well, a deferred sales trust is how you get around this. You start the deferred sales trust in a similar way you would start the 1031 exchange. You find a company you trust and you let them know of your property situation along with the new buyer so everyone's in constant communication. Once the new buyer is ready to close escrow on your property, you sell the property to the intermediary company and they sell the property to the new buyer, just the way it happens in a 1031 exchange. Simultaneously, the new buyer gives the intermediary the money, again just like a 1031 exchange, but the last step is where it gets a bit different. The intermediary does not give you any money. Instead, you and the intermediary will have already worked out a seller finance style agreement. Let's say a fully amortized 30-year loan at 8%. Then the intermediary invests the money in stocks, bonds, annuities, whatever, with the simple goal of paying you back. They simultaneously give you a note stating that they owe you that $2 million over 30 years at 8% interest. This is where it's similar to seller financing. With seller financing, the new buyer pays you the monthly based on whatever the terms that you guys agreed upon were. With the deferred sales trust, the intermediary pays you in the same agreed upon way. So there's probably a few questions you might have. Let me go over some of the more common ones I get. First, is it legal? Yes, it's legal pursuant to the Section 453 of the Internal Revenue Code. Secondly, what's the limit I could put in a deferred sales trust? Well, if you're a single person, it's $5 million, and if you're married, it's $10 million. Thirdly, what happens to the deferred sales trust when I pass away? Well, if you set up the property properly, along with the rest of your estate, your heirs will inherit it and continue to receive the payments. Next, will the deferred sales trust be safe from my creditors? Most likely, your deferred sales trust is not going to be safe from your creditors. But now the biggest and most important question, what, if any, taxes do I have to pay when doing a deferred sales trust? First and foremost, the $23,000 in cost recovery taxes will have to be paid immediately once you sell. Next is the large $132,000 in capital gains tax. This capital gains tax is paid back as you receive the principal on your payments. If the note was set up to be interest only for 10 years with a huge $2 million lump sum on year 11, then you pay 0% capital gains tax for 10 years and a full $132,000 on the 11th year. In our example, we used a fully amortized 30-year loan, meaning that the taxes due in the beginning is going to be relatively small. but as tax payments become larger and larger as the time progresses and you receive more principal payment. Finally, the interest of 8%. This 8% interest you make monthly will be taxed at whatever your ordinary income tax rate is. Again, using the two examples we mentioned, if this is an interest-only loan for 10 years, you will only pay ordinary income tax for 10 years, but none of the capital gains tax on the $132,000. In our full 30-year loan example, you will pay a relatively larger amount of ordinary income tax at first, but the payments will become smaller as time progresses. Deferred sales trusts aren't usually the preferred method when selling a property. Usually that's a 1031 tax exchange. But if by chance you can't or are unable to do so, you can always alleviate the tax burden, even if it's just for an extended amount of time. Now that's good to know.